Level 1, the first mistake. It starts small. You've got dirty money. Maybe from drugs, maybe from fraud, maybe just from running a cash business and skimming off the top. Whatever the source, you need it to look clean. So you do the obvious thing. You deposit it. A few $1,000s here, a few thousand there, straight into your regular bank account. This is the first mistake almost every amateur launderer makes, and it's the easiest one for authorities to catch. Every bank in the country is legally required to file a report on any cash deposit over $10,000. You think you're being smart by staying just under that number, $9,500, $9,800. But banks have seen this exact pattern 1,000 times. It's called structuring, and it's not a loophole. It's a federal crime in its own right. And it's also one of the most obvious red flags a bank's fraud detection software is specifically built to catch. Multiple deposits just under the threshold, spaced a few days apart from the same account. That's not hiding your tracks. That's drawing a map straight to your door. Level 2, learning the basics. After your first close call, a suspicious phone call from your bank, or worse, a visit from a very polite man in a suit asking questions about your cash business, you start learning the actual mechanics of laundering. You learn the 3 classic stages: placement, layering, and integration. Placement is getting the dirty cash into the financial system in the first place. Layering is moving it through multiple transactions, accounts, and sometimes countries, so the trail becomes too complicated to follow. Integration is the final step, making the money reappear as something legitimate, a business profit, an investment return, an inheritance, so you can spend it freely without anyone asking where it came from. You start using cash-intensive businesses as your placement method: a laundromat, a car wash, a small restaurant. These businesses are perfect because nobody can easily prove how much cash actually came through the door on a given day. You simply report more revenue than you actually made, mixing your dirty cash in with the real earnings. It works for a while. But every cash business you touch now becomes a business that regulators statistically flag as high risk, simply because it's one of the most common laundering fronts in existence. Level 3. Building the layers. Now you're moving real money, and a single business isn't enough to hide it anymore. You open a second business, then a third. You start moving money between them: a loan from one company to another, a consulting fee, an invoice for services that were never actually performed. Each transaction on its own looks mundane. Together, they form a tangled web designed specifically to exhaust anyone trying to trace it. You also start using shell companies, businesses that exist only on paper, with no employees, no real operations, and no purpose other than owning bank accounts and moving money through them. You register them in states or countries with minimal disclosure requirements, so the actual owner's name never has to appear on any public document. This is also where many launderers make their second major mistake: reusing the same accountant, the same lawyer, or the same registered agent across multiple shell companies. Investigators love this pattern because once they identify one shell company tied to you, that same professional's name often leads them straight to every other shell company you've ever set up. You thought you were building walls between your companies. You were actually building a single thread that connects all of them. Level 4. Going international. Domestic laundering only gets you so far, so you start moving money across borders into countries with strict bank secrecy laws or minimal cooperation with foreign investigators. You wire money to an account in a jurisdiction known for asking few questions, let it sit for a few months, then wire it back into a different account under a different company name, now labeled as a foreign investment return. This step feels safer because it introduces jurisdiction as a barrier. Even if investigators suspect something, getting another country's banking records can take months or years of legal cooperation. But this is also where you start attracting attention from a different kind of watcher entirely. Not just your home country's financial crimes unit, but international bodies that specifically track cross-border money flows. Every international wire transfer generates records on both ends. Correspondent banks, the intermediary banks that help process international transfers, are required to flag transactions that look inconsistent with a customer's normal business. A small local restaurant suddenly wiring 6 figures to an offshore account with no clear business justification isn't just unusual. It's exactly the kind of anomaly that automated transaction monitoring systems are built to catch. And once flagged, it doesn't just disappear. It sits in a compliance officer's queue until someone decides whether to escalate it. Level 5. The lifestyle problem. By now, you're moving serious money and you've hit the hardest part of the entire process, actually enjoying it. You buy a nicer car. You put a down payment on a house. Maybe you invest in real estate, art, or luxury goods, assets that can be bought and sold with murkier valuations, making it easier to justify sudden wealth. But your lifestyle has a math problem your reported income can't explain. If your restaurant reports $80,000 a year in profit, but you're driving a $150,000 car and buying $1 million house in cash, that gap doesn't just raise eyebrows. It's one of the single most common ways launderers get caught. Investigators don't always start with the money. Often they start with the lifestyle, working backward to figure out how someone is affording a life their declared income doesn't support. Luxury purchases also generate their own paper trail. Car dealerships, real estate agents, jewelers, and art dealers dealing in large cash transactions are subject to their own reporting requirements in many countries, meaning the exact same red flag that catches structured bank deposits can just as easily catch a suspicious cash purchase of a Rolex or a Ferrari. Level 6. The human weak links. At this stage, you're no longer working alone. You've got a network. People running your cash businesses, an accountant handling the books, maybe a banker somewhere who looks the other way in exchange for a cut. Every person you bring in isn't just help. They're a liability, a potential witness, a person who might get scared, get arrested for something unrelated, or simply get greedy and start talking. This is how many major laundering operations actually collapse. Not through some brilliant piece of forensic accounting, but through a single weak link flipping on everyone else in exchange for a reduced sentence. Prosecutors know this, and it's often their primary strategy. Arrest the smallest, most replaceable person in the chain first, and offer them a deal in exchange for testimony against the people above them. The bigger your network gets, the more chances there are for exactly this to happen. Level 7. The data trail you can't erase. By now, years of transactions have created a digital footprint far larger than you realize. Every wire transfer, every large cash deposit, every suspicious activity report filed quietly by a bank employee who noticed something offy, none of it disappears. Financial institutions are required to retain these records for years, and specialized financial crimes units use software specifically designed to detect patterns across thousands of accounts simultaneously. Unusual transaction timing, connections between seemingly unrelated companies, sudden spikes in specific business types known for laundering. You might never even know you've been flagged. Suspicious activity reports filed by banks are confidential. The bank isn't allowed to tell you they've reported you. For months, sometimes years, an entire case can be building quietly in the background while you continue operating, completely unaware that investigators are already mapping out your entire network. Level 8. The investigation closes in. Eventually, enough red flags accumulate that a formal investigation begins. This isn't a single dramatic raid. It's usually a slow, methodical process. Subpoenas for bank records, surveillance on your businesses, undercover agents posing as clients or investors, financial forensics experts painstakingly reconstructing years of transactions to build a clear map of exactly how money moved from illegal source to clean bank account. At this stage, investigators often already know far more than you'd expect. They may have already flipped one of your associates. They may have already subpoenaed records from the shell companies you thought were untraceable. By the time you notice something is wrong, a strange car parked outside your business, a client asking oddly specific questions, the case against you is often already largely built. Level 9. The takedown. The end usually comes fast and coordinated. Simultaneous raids on your businesses, your home, and the homes of your associates, timed specifically so nobody has a chance to warn anyone else or destroy evidence. Assets get frozen immediately, bank accounts, real estate, vehicles, often before you're even formally charged, because prosecutors know that giving you time means giving you a chance to move money one last time. Level 10. The reckoning. What follows is less about the money and more about the math of federal sentencing. The total amount laundered, the number of transactions, the sophistication of the scheme, and whether you cooperate with prosecutors against others in your network. Cooperation can mean a lighter sentence. Silence, in a case this well documented, rarely helps. Because by the time it reaches trial, the paper trail usually speaks louder than anything you could say in your own defense. Every business you built gets seized and liquidated. Every relationship built on your fake wealth quietly dissolves. And the entire elaborate structure, the shell companies, the international wires, the layers of financial paperwork, is revealed for what it always was. Not a system that hid the money, but a system that, one transaction at a time,